Preparing for gold, here's how you can invest in the yellow metal. Hello, I'm Rachel Jones and you're watching Kalkinemedia. Today we're looking at gold. From time immemorial, gold has been used as the world's currency of choice. Experts advise investors to include safe haven gold in their investment portfolios to lower overall risk by using it as a hedge against political unrest and inflation. An investor takes up the ownership of the asset up front and profits if gold prices surge. On the other hand, a trader doesn't take up the ownership of the asset itself, but takes up a position on the underlying price, rise or fall. There are different types of gold assets available for you to trade or invest. Firstly, jewellery. Even though it's easy to acquire, jewellery is not considered a good option for investing in gold. Due to markups in the jewellery industry, investing in jewellery is not considered to be a very lucrative option. Also, the resale value of jewellery is known to fall materially after the purchase. Next, you have physical gold, bullion. That is, gold coins and gold bars. These are the most common way to use and store gold by individuals and banks. However, active investors are deterred by costly safekeeping and insurance requirements in the case of physical gold. The other important thing to keep in mind while investing in gold bullion is that it's a direct investment in gold's value. So with a change in dollar value, the value of the investor's holdings would also proportionately change. So then you have gold certificates, another way to own gold without having a direct exposure to it. This is via gold certificates. Now these certificates are notes issued by a firm which owns gold. There is no specific gold backing the certificates. These notes are as good as the firm backing them. However, the major disadvantage with these notes is the costs associated with them. Then there is exchange-traded funds or ETFs. Now these funds track the movement of shares of publicly traded gold mining, refining and production companies. ETFs are widely popular since trading or investing in them provides a much better exposure to a wide range of stocks in a sector, which can help in diversifying a portfolio. These funds are passive investments. Also, we have future contracts. These are another popular way to hold gold indirectly. However, future contracts are a highly leveraged and risky option for newbies. A futures contract is basically a legal document to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. Futures contracts are standardized for quality and quantity to facilitate trading on a futures exchange. These are generally traded on stock exchanges such as the ASX. However, one major disadvantage of future contracts is that they're generally purchased with just a small fraction of the total contract cost. It increases an investor's potential gains and losses. In addition, future contracts come with end dates. So then we have the basic gold stocks. Owning shares in the companies that deal with the yellow metal can also provide an indirect exposure to gold. There are several firms which also offer regular dividends to their shareholders. Gold price is mainly determined by supply and demand. There are several factors that can impact the market price of the yellow metal. Investors and traders should devise proper strategies before investing in any of the listed options here. Now, if you like this information, please like, share and comment on this video and subscribe to our YouTube channel. Press the bell icon for notifications of our latest videos, and for more information log on to our website kalkinemedia.com. I'm Rachel, signing off for Kalkinemedia.